The balance sheet is one of the three major financial statements. In this video, you'll learn what the balance sheet is and how you can use it to monitor your business's financial health. If you haven't subscribed yet, hit the subscribe button and turn on the bell so you know next time a video is uploaded about all things business money. I am Annette Ferguson, Chartered Accountant and Certified Profit First Professional, and I run Annette Co, a UK-based accounting firm. A balance sheet states a business's assets, liabilities, and equity at a specific point in time. It is a snapshot of what the business owes, as well as what it owns and the amount invested by its owners. The balance sheet essentially tells you the business's worth at a point in time so that you can understand its financial position. The assets section of the balance sheet is typically shown at the top, and it breaks down what your business owns of value that can be converted into cash. There are two main categories of assets included in your balance sheet. Current assets. These are those that are easily converted to cash within a year or less. Current assets are further broken down on the balance sheet into these accounts. Cash and cash equivalents, they are the most liquid assets, and they include currency, checks, the money stored in your business's bank account, including business savings accounts. Marketable securities, investments that you can sell within a year. Accounts receivables or trade debtors, money that your clients owe you for the services that will be paid in the short term. Inventory or stock for businesses that sell goods. Inventory also includes finished products and raw materials. And prepaid expenses, things of value that you've already paid for, like your office rent or business insurance. We then have long-term assets. Long-term assets won't be converted into cash within a year. They can be further broken down into fixed assets, which include property, buildings, machinery, and equipment like computer equipment. Long-term securities, which are investments that cannot be sold within a year. And intangible assets. These are assets that aren't physical objects and include things like copyright, franchise agreements, and patents. All of that make up this top assets section of the balance sheet. The next section of the balance sheet is the liabilities. It lists your company's liabilities, and the liabilities is the money that you owe to others, including your recurring expenses that are outstanding to be paid, loan repayments, and other forms of debt. This includes any money that you may have put in the business that the business owes to you as well. Liabilities are broken down into current and long-term liabilities. Current liabilities would include things like taxes, current payments towards rent and utilities outstanding, and any current payments owed to longer-term debt, interest payments, and payroll. Long-term liabilities include the longer-term loans, deferred income taxes, and pension fund liabilities. If this video is resonating with you, please do remember and hit the like button. Shareholders' equity, or the capital and reserves section of the balance sheet, is that part shown at the very bottom. This refers to the amount of money generated by a business, the amount of money put into the business by owners, and any other donated capital. By the amount of money put into the business by owners, in this instance, we mean through share capital and not through director's loan. In other words, shareholders' equity is the net assets on the balance sheet and is calculated using the formula shareholders' equity equals total assets less total liabilities. So you can see in this balance sheet that the total of this capital and reserve section equals the same as the total of this net assets section. That is a balance sheet balancing, and a balance sheet must always balance. The numbers in these two sections always have to equal each other. So how do we analyze the information in the balance sheet? Well, looking at the balance sheet is just a start. We need to understand what it actually means in order to understand the financial health of our business. The simplest way to do that is to first off look at this net assets number. If this number is negative, the business is technically insolvent. Therefore, we do always want to make sure that our net assets number in our business is positive. Otherwise, it is a big red flag to the future viability of a business. If the number is negative, it essentially means that the business owes more money out than it is able to redeem in based on the value of its assets. Typically, a business with a negative balance sheet will have major cash issues and usually will be struggling to pay its debts as they fall due, which is another big flag for insolvency in a business. If your business is in this position where you have a negative balance sheet, I highly recommend that you speak to your accountant or an insolvency specialist straight away so that you can try and work out what to do in this situation, because you are not supposed to be trading a business when it is technically insolvent. Other techniques that you can use to analyze your balance sheet include a bit more maths, because it's involving looking at financial ratios in your business. Financial strength ratios include debt to equity ratios, and you can also get activity ratios, which look at things like debtor days, creditor days, and other metrics within your business. So how do you see the balance sheet in your business? Well, when your accounts are drawn up for Companies House, a balance sheet will be part of that preparation, and a summary balance sheet is submitted to Companies House as part of your filings. Therefore, you should at the very minimum be seeing it once a year when you sign off what is to be filed at Companies House. But if you are running bookkeeping software like Xero or QuickBooks, then you'll be able to run a balance sheet report within those as well and monitor your balance sheet on at least a monthly basis, which is what we recommend that people look at their balance sheet in that frequency. When you look at your balance sheet, you at very least want to sense check the numbers in there. Do they make sense to you? Does the age debtors and age creditors number make sense knowing all that you know about your business? Does the fixed asset number make sense? Does the cash in the bank number make sense? And do the liabilities, the amount that your business owes to others, does that make sense when you're looking at it? Like I mentioned too, you want to make sure that that net assets number is a positive number. And if it is not, that's going to be a flag that needs to be addressed ASAP to ensure that your business can continue trading. And if you wanted to start digging deeper into the numbers, then looking at some of those financial ratios that you can calculate off of your balance sheet data would be the next step forward. But the first step is making sure you review that balance sheet report at least monthly for your business. Remember, the balance sheet is a snapshot in time, so typically it's run at a certain date. So if you're running it on a monthly basis, you're going to want to typically choose the end of the previous month as your as at date to look at that snapshot of the assets, liabilities, and equity of the business at a single point in time. And if you are struggling with the accounting for your business, I would love to help. Do pop me an email to yt@annetteco.co.uk and let me know how we can support you. Thank you so much for watching. Hit the like button, subscribe, and I'll see you in the next video.